Growth stocks had their ups and downs this year, and SCHG has been no exception. But how has it really performed in this market? Let's dive into the numbers and see if this growth ETF is still worth holding. As we look into our hypothetical scenario that we've used before, and we'll update it with the latest information. Welcome back to Simply Money. Today we're going to be looking at an updated hypothetical scenario with SCHG. We do this periodically with different ETFs just for you to get some insight for educational purposes. This is not financial advice. We're not telling you to go buy SCHG. I've done other videos on SCHD, JEPQ, SOXX. Today we're looking at SCHG, how it's been performing, and with the latest update. We've added a few things on looking at the annual dividend growth, and the annual dividend payment, along with what is the yield on cost on these different ETFs. Today, we're going to be updating SCHG on this scenario. Let's look at the graph real quick, just to recap for those who have seen this before, or for those who are new and never seen one of these videos. We're looking at a scenario where we purchased SCHG on March 1st, 2017. We invested a one-time lump sum of $50,000, and at the time, the price was $7.63. This has all been adjusted to the latest 4-to-1 stock split. All prices, dividends, and everything have been adjusted. The price adjusted with the stock split on March 1st, 2017 was $7.63. That was able to get us 6,553 shares of SCHG. And so we'll look at the first year, 2017, just to get the ball rolling here, and then we'll skip every couple years, and we'll go through the growth, the ups, the downs, the concerns people have, and where it's at in the latest with the December 2024 dividend being paid out here in another week. As you can see here, 2017, the dividend per share. Now, again, this is all rounded. We could add all this in, and we could put all that in the fractional pennies. I don't bother. It'll add it up over here. As you can see, the dividend per share, it was 2 cents. In September, it was 3 cents. And then December, it was 2 cents. So that gives you your 9 cents. And each quarter, when that's paid out, your dividend payment, the first quarter there was $111. You can see it went up to $171. It was down a little bit with the $145. Your total for the year was $559 that you got from this $50,000 investment. But also notice that your value has gone up. You got up to almost $59,000 in value because the share price is gaining as well. So not only are you getting a dividend, you're getting the share price increase. Now, this isn't an ETF for those looking for income. The income, the dividend is just a little extra there. This is strictly a growth fund. These are large cap stocks in this ETF, and they're designed for growth. And so it's not like SCHD where you're looking for dividend or dividend growth. This is strictly market value growth that you're looking for in this, and the dividends are just a bonus. With those dividends, we reinvested them. And so you can see the quantity that each quarter you're able to buy 14, 16, 20, and 16 extra shares. You see the cumulative quantity of the shares that you now own, which is helping drive up this total value because now you own about 70 more shares than you did before, and that helps your portfolio value. So reinvesting dividends, the dividend reinvestment drip, is very important. Now let's look at 2018 and 2019. Come all the way down here to 2019. As you can see, the dividend per share stays about the same, 2 cents. Every once in a while, it's 3 cents. Never goes over that for these next couple years. You can see your dividend payments. Again, they're staying around the same. You have some that go a little higher when it's 3 cents. When it's 3 cents here, 3 cents here, and then back down to 2 cents. You can see the stock prices slowly going up. It drops a little bit and goes back up. Now, being a large cap ETF, the volatility is going to be a little bit higher. You're going to have greater reward, but also greater risk. The beta is a little bit higher than the standard of the S&P 500. You'll see a little more volatility. When it's down, it'll probably be down a little bit more. but when it goes up, it should be up higher than the S&P 500. So this is a growth stock that has a little more volatility than just a straight S&P 500. All right, so now looking at 2019, at the end here, you can see we're at $76,000 of value. Now, the annual dividend growth this first year was nice, but then it dropped. Again, this isn't like SCHG where you're having dividend growth year over year. You're going to have lower dividends sometimes. This is about market value gain. And as you can see here, $76,000. In 3 years, you have gained $26,000 in this portfolio. That's a nice gain over a 3-year period on a $50,000 investment. You've also had some dividend payments. You can see your cumulative dividends have increased. We're going to continue down here. We're going to go down to 2021. Now, 2020, remember we had COVID hit. And look at this share price. It went from $11.31 at the end of 2019, dropped down $9.55. Your portfolio dipped. Now, I was like sharing this with people watching these videos. This right here is a time where people panic. If you recall, in March of 2020, the market dropped everything. The whole world was in chaos, wondering what was going on. There was shortage. Supply chains were all backlogged. There was no production of goods. Things were getting really bottlenecked, and the market dropped and reacted to that drastically. That was a short-lived one. You know, hindsight, we can look back and say, okay, it was only a few months and then things recovered and took off. But it's during this period, these few months, where people panic and they see their portfolio dropping. But right here, if you were to look and you say, oh my gosh, my portfolio dropped $8,000. That's not how you need to look at this. You need to remember you invested $50,000, so you're still up $14,000. You're not in this for 3 months. You're not in this for 6 months. You're in this for long term. And you need to be able to ride out those dips, because following dips, you usually have accelerated growth. And we want to look at that. As you look at 2020 into 2021, it went from, oh, we're panicking, to look where we ended up at the end of 2021. At 2021, we ended at $141,000. So you can look over here. The dividends remain the same, 2 cents to 3 cents. This one was a 1 cent. This is a special dividend. As you can see, there's 2 in December. At the end of the year, they paid a special dividend payment. You got a little bit extra dividend payout. But the big thing I want you to see is, look at the panic that you could have had here. But if you rode that out for the rest of the year and then into the following year, you're up to $141,000. Now you're really like, oh, this is great. This is the difference where people lose money in the stock market. It's because they sell out of panic. They're emotionally driven. I encourage you to read The Psychology of Money. There's a link down in the description below. It's a great book to give you an understanding of the different mindsets people have with money. And you need to understand your mindset. What is it that drives you? What is it that you react to? If you can't handle the volatility, SCHG would not be a ETF for you, because it is more volatile. But if you can handle the ups and downs and not panic, the reward is substantial. You're not going to lose all your money. If you lose all your money, we are in a heap of trouble, because think about COVID. And now, again, that was short-lived. You didn't lose all your money. You just had a slight drop of $12,000. That's okay. You have a drop, but you didn't lose all your money. In fact, you're still up $14,000. Get the mindset of, I didn't lose all my money, or I'm losing all my money. Just my growth is down. You haven't taken any of this out. It's still there. And if you just let it continue to ride, now you're up. From your original investment, you're up $90,000. Well, I'm glad I didn't sell when I was down $12,000. Now I'm up $90,000. This is where you need to be able to relax and watch. Now we're going to go into 2022. This was a very volatile season for the stock market. 2022 had lots of ups and downs, very turbulent. And this is, again, a period where people panic and sell. They see it dropping, they panic. They read the news, they hear something chaotic going on, and they panic and get out. As we skip down here to the end of 2023, we'll go down all the way down to 2023. And we're going to look at 2022 real quick. As we look at 2022, you're at your high here of 140,000. Then it dropped down to 124, all the way to 99,000. So COVID, you're freaking out. Oh, it's down 12,000. Now your portfolio is down 41, almost $42,000. Again, freak out mode. Oh my gosh, we're losing all our money. No, stop, relax, think, put it in perspective. You were still up $49,000 from your original investment. You were still up $49,000 from your original investment. That's the mindset difference between I'm losing everything, the stock market's going crazy, I got to get out, and you jump off, versus I'm just going to ride this dip. In fact, COVID 2022, I was looking for as much cash as possible to throw into the market because it's on sale. It's funny how somebody can go walk by a store and see something they absolutely don't need, but it's on sale. Save 50%, 30% off. And all of a sudden they have this urge that they need it because it feels like such a bargain. When the stock market's down, we panic, we get out of it. It's like, no, I don't want your sale. I don't want to save money. And we freak out. This is where I'm looking at this and saying, oh, this is on sale. It's 25% off. It's 50% off, whatever the case might be. And I'm evaluating, is this a place I want to put more money in? Because I all of a sudden have an urge that I need to make more money when this thing kicks back up, which it will, because the market does. It ebbs and it flows, and this was a downturn, and it took back off. As you can see, it fluttered around this for most of the year, and then 2023, look what happens. Now we're back up to almost where we were in 2021. And you say, well, I should have got out in 2021. That's where people get in danger again, trying to time the market. Did I get out at the perfect time here? Or maybe I waited to here. Or maybe I panicked here, thinking I'm going to get out before it goes any lower. And then all of a sudden they miss the upside. So timing the market is the worst thing you can do. You want time in the market, not trying to time the market. That is an old saying that you have to get into your head. If you're going to invest in the stock market, don't go into single stocks, diversify with ETFs, index funds, and then be in it for the long term. Okay, so at the end of 2023, I'm sorry, we're come down here because one more here, 143. We were above. I lied here. That was because they had again another special dividend. There was 2 dividends in December. If you look at your end value, you're up from that high back in 2021, where you could have started panicking in 2022. You've regained all that it dipped and gained some. During that time, look what happened. Your dividend payments per share were the same, but look how many more shares you were able to buy. You were able to get all these extra shares, and when the price was down, look, you got 9 shares versus other times when you only got, 5 shares. Or 7 shares. You're getting more shares because the price is lower when you reinvest. And instead of paying $20 per share, you're only paying $14. Again, it's on sale. That's a great sale here. I don't necessarily want to buy here. I want to buy here. But that's not how I approach it, and how I encourage people to approach it is just dollar cost average. Every month, every quarter, every week, however you do it, put money in and just buy it. Sometimes you buy some shares at $20. Sometimes you buy them at $18. Sometimes you buy them at $14. It's dollar cost averaging. Your average cost isn't the high. It's not the low. It's the average. And that's how you beat the stock market, frantic buying and selling and all that emotional chaos that goes into it. All right, for our big update, let's go down here to the end of the sheet. As you can see, 2024, I'm glad I stayed with SCHG, because now, instead of freaking out in 2022 at $99,000, look here, at the end of 2024, we're not quite there yet. And I used December 9th as of when I'm videoing this. I use that share price, and that's what's in here, based on what the dividend will be on the 16th. I'll adjust that, but it's going to be pretty close unless something crazy happens in the next couple days. But I'll make that adjustment when the time comes. I just want to get this video out for you. As you can see, $199,000 is what the value would be. $50,000 investment, 7 years. Now you're at $200,000 basically. Your dividend payment is $732. The dividends haven't really gone up. Now they're a little more consistent at 3 cents with a little dip down to 2. Your dividend payments have gone up slightly. Again, this isn't about dividends. This isn't about dividend growth. This is about value, share growth. Let's look at the overall cumulative dividends in these 7 years. You've made $5,000 of dividend payments. The share price, the price from when you first bought it at $7.63 to $28 now, you've gained 276% growth. Your shares are now worth that much more. You've been able to buy 378 more shares out of reinvesting your dividends. Now you have 6,931 shares. Your gained value, the total value that you've gained between dividends, reinvesting, and your share price appreciation, you've gained $149,299 of value. When you're getting ready for financial independence, to retire, whatever the case may be, this is where you can look and see long term, this is going to grow and build wealth for me. Your total growth, 300%. 300% growth is the share appreciation and the dividends, all that added together. Your total return has been 300% on that $50,000 investment. This is the power of compounding. This is the power of staying the course, buying and holding, and not panic selling. I want to encourage you. What are your thoughts on SCHG? Give me a comment down below. Do you hold SCHG? How did you deal with the 2020 COVID, the 2022 market turbulence? How are you dealing with the up market right now? Because not only do people panic sell when it's down, when they see it starting to go up, they're like, oh, this is really growing. They start buying more. You're emotionally driven on your buying and your selling, and that's not how you should operate this. You need to have a game plan and be consistent and not let the turbulence dictate what you buy and sell and when you buy and sell. That's it for today. Hit that like and subscribe button. It helps the channel out. It doesn't cost you anything. I appreciate you joining me, and we'll see you next time on Simply Money.